guests. They're here somewhere. He has multiple financial service licenses and has also recently received his Certified Retirement Counselor designation. So we're pleased to have Art here. In addition, I know most of you know the next person I'm going to introduce, who is Melissa Dowdy. Melissa, of course, has been our representative here with the county, and she is a retirement plan specialist from ICMA, been working with us for the past 8 years, and we hope she continues. She has been with ICMRC for 12 years. She is a graduate of Virginia Tech and holds her, oh, there you go. They just aren't here. And holds her Series 6 and 63 financial services licenses. And she holds 14 years of total financial services experience. So we're delighted to have Melissa here today joining us. And we also have a person that you probably don't know real well, but he has been here before, Mark Houston. He is ICMARC's financial planning manager for the Southeast. He has over 30 years of experience in the financial services industry and became a certified financial planner in 1999. He started his career as a stockbroker with Merrill Lynch in Atlanta, Georgia, and prior to joining ICMARC, he worked as a Department of Defense contractor, providing financial planning and counseling services exclusively to the members of the U.S. military. So I'd like for you to help me in welcoming them all here today. We thank you for coming to join us. And with that being said, I'm going to turn it over to Mr. Art, and he's going to take it from there.
Well, good afternoon, everybody. I know you applauded for me, but we'll applaud for you. Thank you all for being here. We really appreciate the opportunity to stand before you today to talk a little bit about how to invest for today and tomorrow, dealing with current market conditions. That also might be known as, or a better title might be, what should I be doing with all this market volatility? The stock market continues to go up, it continues to go down. How should I be investing my portfolio? So that really is our goal today, to kind of give you some do's and some don'ts, maybe some tips as well, kind of help you navigate through this sort of rocky scenario that we've been in for many, many years. And I think ultimately, living so close to the coast, the goal really is to have you a successful retirement and maybe toes in the sand and drink in the hand, right? That sounds good, I think. And so that's really kind of our goal today. We want to help you have a better retirement. One last comment. I want you to know you're not alone. Here at ICMA Retirement Corporation, we're here to help. We come every Wednesday to take care of new employees, but we also do individual meetings. We've been out to various department locations. So I want you to know you're not alone in this. This is not just we give you a list of do's and don'ts and then we wash our hands and say good luck. We're really here to help you. So please let us know. If we can come out to your department and meet with you, meet with some of your peers, we're glad to do that. Otherwise, every Wednesday we're here after new employee orientation. We can meet with individual employees as well to kind of help you if you just want to do a sort of retirement plan checkup. How is my retirement plan looking? Where am I? Where might I be when I retire at 65? How do my investments look? That's really our job here, so we want to make sure that everyone knows. Please take advantage of that opportunity if we can help. What I'd like to do now is move into the presentation, and today we're going to kind of focus on what we can control. Because there's a lot of things out there that you can't control. You can't control the markets. You can't control the economy. Can't control whether or not a president's going to get into trade wars, right? That's not a political statement, I promise. But you have really no control over some of these economic, political things that happen throughout your working career while you're saving for retirement. But there are some things, you can control. You can control having a plan. You can control how much you save. You can control where your money is invested. So we really want to help you sort of focus on today on the things that you can control, and maybe kind of not focus on the things that you really can't. Anybody have control? Let me see this. Raise your hand if you single-handedly caused the recession in 2008. Okay, raise your hand if you spent enough money to singly get us out of the recession in 2008. Okay, good. The point being, you really have no control over some of these things, but there are some things you can control, and we're going to focus on that today. I'm going to cover the don'ts. There's kind of some don'ts we want you to think about. Mark's going to handle the do's, and then we're going to bring Melissa in to talk a little bit about some tips that you can take home with you to implement into your current retirement portfolio strategy. So this is a public meeting. It's being recorded, so I'm not going to share with you what my dad said about the word assume. If you know the phrase, help your neighbor, because I see some people going, what is he talking about? I can't say it because it's a public meeting, but a lot of this is going to be about making some assumptions that you really shouldn't be making, but a lot of times we see participants make. They make assumptions about the stock market, about the economy. Here's a really good one. so-and-so is going to be elected president, so I'm going to go ahead and sell now because I think the market's going to go down. I hear that all the time. People are so afraid with their retirement money of who's going to be the next president that it's really a big don't, because studies have shown, and Forbes did a study, you all know who Forbes is, in Forbes magazine. They did a study to determine which political party had the best performance in the stock market. Anybody want to take a guess? Yell it out. Neither. That is the answer. I was hoping someone would say Republicans, because in fact, if you look at the overall rate of return, Democratic presidents have actually had a better rate of return for markets. Is that surprising? Well, before the Democrats get in everybody's Republicans' face and go, "I told you so," keep this in mind as well. It is neither, because when you look at economic policy, some would argue that it takes 4 to 6 years before that policy really gets a hold and has an impact on the economy, which means it might have been the prior president and their economic policies that actually moved the market. So the point being is there really is no Democratic or Republican Party. You probably have heard this through the election, and probably even in the last election. President so-and-so is going to be better for the economy. When you look at the statistics and you look at the facts, it's absolutely not true. So don't assume the future. When you make changes to your portfolio, you need to make it based upon lifestyle changes, getting closer to retirement, not about all these different things, what you hear in the news. News reports often overstate the importance of certain events, and statistically speaking, there's not a lot of impact on the market when you're talking about specifically political climate. So the next slide is really don't assume performance, and this is really, really important. Let me get closer to the mic because I think we're being recorded, but this is really, really important, because the absolute worst thing I've seen employees do when they get closer to retirement is they say, "I have not saved enough. I need to get more aggressive with my investments because I'm getting closer to retirement. I need to catch up for the years that I didn't invest." That's not what we really want to take a look at when we look at saving for retirement. We really want to look at your time horizon to retirement, your risk tolerance, all these other factors. But a lot of people want to take more risk as they get closer to retirement because they assume the stock market's going to go up forever and they can catch up for lost time. I want to share a statistic with you. If you invested $10,000 in specific different periods of the market, you can see one period was really, really good for you, 1979 to 1999. That $10,000 turned into $48,000. That's the kind of return I'm talking about, right? But from 1961 to 1981, that $10,000 shrunk to $6,600. That's not what we want. So the challenge that you have and the problem you face if you get too aggressive as you get closer to retirement, what if it's a repeat of 61 to 81? You're going to be really in trouble when it comes to your retirement assets. So we can't assume performance. The stock market doesn't always go up. So I guess point number 2, again with assumptions, don't assume the market's going to be good at all times, because it is not. Another one is don't chase performance. A lot of times we have participants come to us and say, "I've seen this really good performing fund in the lineup, so I want to sell my other investments and I want to get into this top performing fund." But what you'll find when you look at studies is this year's best performing fund or top performing fund is next year's not best. And in fact, anybody heard of Vanguard before? They're one of the largest mutual fund companies in the world. They did a study and they used a company called Morningstar. So Morningstar is a company that rates mutual funds. And what they do is they look at past performance and say, based upon past performance and comparing this fund to a similar mutual fund in that category, 5-star is the best performing, top 10%, 4-star is the next, 3-star is middle of the road, 2-star is not really great, and 1-star is the worst. They looked at a 3-year period of 5-star rated funds versus a 3-year period of 1-star rated funds, which were kind of the worst performing when they're looking for past performance. And this is a loaded question, but which do you think performed over a 3-year period better? Which was the average rate of return, the 1-star or the 5-star? The 1-star. So a lot of people come in and they chase performance, but it's a big mistake because, again, when you look at studies, this year's best performing fund is next year's not best. I'm not saying it'll be the worst, but what I am saying is that you can't chase performance because it's not always going to work in your favor. So here's another example of that. When you're predicting performance or chasing performance and you're trying to figure out which part of the stock market might be the best part. This is something called a quilt chart. And basically what it does is shows you different asset classes. So there's large growth, small growth, there's bond, there's balance, there's cash. If you look in the upper left-hand corner, and I apologize that our pointer doesn't work on the TVs because they're so advanced. It's like HDMI or something in it. But if you look in the upper left-hand corner of 2007, you see large growth, that green box. That was the best performing sector in 2007. It garnered you an 11.81% rate of return. Look what happened in 2008. Large growth was down 38%. And then in 2009, it was again the best performer at 37.1% positive. And then in 2010, large growth was 16.71. You see that green box under 2010, about 3 boxes down. This is the point of chasing performance. Because what happens is, once it's been a really good performer, you put all of your money in it, guess what happens the next year? It goes down, right? So you sell it, and then you miss all the upside when it comes back, and then you go chase it again. And I've always told folks that buying high and selling low is no way to make money in the stock market, right? So chasing performance, trying to predict performance is very, very difficult to do. They pay people from Harvard and MIT millions of dollars a year. And studies have shown they're right about 25% of the time, okay? So the whole idea is we don't want to chase performance. We want to have a balanced portfolio. We want to diversify you because, look, in 2007, if you had large growth, if you had some international, if you had some small growth, you had some bond, you did really well. And then when it moved over to 2008, you'll see the bonds were the best performers. You had a little bit of that because you had diversified portfolio. The next year was, large growth and small growth. If you have a little bit of each of these in your portfolio, then you're going to take advantage of these big runs in these different asset classes because you have that diversified money. So the takeaway from this slide and the slide previously is don't chase performance. Have a diversified portfolio. Mark's going to talk a little bit more about the do's in a minute. This is one of my favorite ones. This is don't time the market. A lot of times when we sit down with participants, they always ask, what's the market going to do? Should I sell all my investments and get in cash, let the market drop, and then I'll buy back in? In theory, that sounds really good, but the whole idea is that it's very difficult to predict when the market's going to go down, when it's going to go up, when is it going to rebound, and so forth. So Mark Twain said, October is one of the very peculiar, dangerously months to speculate in stocks, and then he starts to list all the other 11 months of the year. So the whole idea is, and it's a true statement, it's very difficult to time the market, try to pick what tomorrow's winners are going to be. That's why we always talk about diversification. The next quote is by Peter Lynch. He was one of the premier money fund managers. He managed a fund called the Fidelity Magellan back in the 80s and early 90s. He's very colorful guy, very tall. He had one of those big wafts of hair, the ones I'm jealous about. But super intelligent guy, very successful investor. And you can see here he says, far more money has been lost by investors trying to anticipate corrections, meaning trying to time the market, than has been lost in all of the combined corrections. So again, a very intelligent, successful investor saying timing the market is not a good idea. Last study, then we'll move on. So if you look at, and I believe the time frame is 1996 to 2015. If you look at the S&P 500, which is an index of the 500 largest companies in terms of revenue, over that time frame, that's about a 10-year period, those stocks returned an average of 8.9%. Anybody want to guess what the average investor did over that same time frame? Throw out a number, it's okay. Anybody want to guess? Oh, I heard half. Good job. Nice job. 4.97%. So the market did 8.9, but average investor did 4.7. Why do you think that is? They're selling high and buying low, right? They're trying to time the market. They're trying to jump in and out. That is a big don't in investing, and I just want to hit home this point. If you're doing that, please stop. Come see us. We want to help you because it's one of the better ways to ensure that you don't retire successfully because it's very, very difficult to time the market. So good study there. Lastly, don't be too overconfident. I only have to say one word, and everybody knows this company. Anybody ever heard of Amazon? Everybody's heard of Amazon, right? And I have employees come to me and they say, I want to get into Amazon stock because it's basically the next Walmart. It's going to go up forever. I mean, that's what they really believe. But the reality is you can be very overconfident about a company and be wrong. It can still be a good company, and when the market goes down, it can go down with it. Good companies also have corrections just like the stock market does. So let me give you its stock price. On October 1st of 2013, Amazon stock was, to be exact, let me give you the right number, $320 per share. Today, actually as of yesterday, $1,925 per share. Some people still want to buy Amazon because they think the stock is going to go up. And please, this is legal and compliance. This is not a recommendation to sell your Amazon stock. It's not a recommendation not to buy it. You know, we're here to help you, but the reality is that you can be overconfident about a company and still not make money in the stock market. On average, something called price to earnings ratio, the price you're paying for the stock versus the earnings that company is generating. On average, what would you say, Mark's a good number? 15 to 25, I think, is probably a good number. Did he shake his head yes? I don't know. Okay, good. Good, thanks for backing me up, man. I appreciate it. Anybody want to guess what Amazon's price to earnings ratio is right now? 151. You're paying 151 times earnings. Some people would argue, well, you're paying for the future potential growth, okay, and that could be okay. Other people say, that thing's way overvalued. Don't be too overconfident. So, again, not a recommendation to buy or sell Amazon stock, just to bring home the point that companies that do very well are not always going to do very well. I mean, Walmart was a no-brainer for many, many, many years, and then what happened? In comes Amazon, and now Amazon is the new Walmart. Who knows when the next company will come in that'll take Amazon's place? You have to be very, very careful about individual stocks. One last point. In your 401 and 457 plans, the good news is I think you're buying mutual funds, right? So you're buying groups of stocks. Your money's not all invested in Amazon or IBM or Coke. It's invested in many, many different stocks. And then you have many, many different funds as well. The point being that you're very well diversified in your portfolios. And the good news is if Amazon were to go down or up or whatever, you know, it's not necessarily if it goes down going to hurt you too bad because you don't want to have all your eggs in one basket. So just an interesting a comment about don't want to be too overconfident. Last point, then I think I need to turn it over to Mark. This is another a big don't in the stock market investing, and that is don't panic sell. This example was if you had $100,000 in the stock market when the downturn began during October of 2007, that was the recession of 2008 we're all too familiar with. The low of that was your $100,000 in February of 2009 was at about $49,051, okay? And then in 2012 was about what it took for you to come back and break even if you were to stay in the stock market. If you had been stayed invested the whole time, that $100,000 would be worth about $166,000 today. But here's the point. Some folks get very, very emotionally tied to their retirement monies, and maybe rightfully so. But the stock market will go up, it will go down. But when it goes down, some people get so nervous and so panicky that they go ahead and sell. And they say, I'll sell now, and I'll wait for the market to return. But they sell, then they get back busy with their lives, taking care of kids, doing their jobs, doing the work. And pretty soon the markets come all the way back, and they've missed all that upside as well. So, you know, the whole question is, in 2009, if you sold out at the bottom, you had $49,000. If you never got back in the market, you could have been at $166,000, but you're still at $49,051 plus interest. And so that's over $100,000 error because you sold when the market was going down in a panic sale as opposed to just riding it out. You know, in retirement planning, we talk about time horizon till retirement. I'm 47 years old. I'm trying to get out of here at 59. That's 12 years for me. I do care, but I don't. If there's another recession next year or the year after or the year after that, it doesn't bother me because I'm still worried about 12 years from now. I'm not worried about tomorrow or next year or 2 years from now. And I don't want you to worry about that either. If you're in a right portfolio, if you're diversified, if you're investing age appropriately, the whole idea is that you can ride out these ups and downs. And it's better, studies have shown year after year, you're better off riding out the ups and downs as opposed to trying to sell when you think the market's going to go down and trying to buy when you think the market's going to go right. Those professionals that are getting paid all that money are right only 1 out of every 4 times. How about the average investor? How often are they going to be right? A lot less than that. So the whole idea is invest in your portfolio and stick with it. This is the S&P 500 over a 5-year period. I mean, you could pick any day, and I could put a piece of paper over the chart, and we could play a game where you could guess, is the market going to go up the next day or down? But you could see you're going to be wrong a lot of the time because there's a lot of ups and downs here over the last 5 years. Again, the point being is don't try to time the market. Don't try to predict performance. Don't try to outsmart anything other than just have a great portfolio, stick with your portfolio, and then come meet with us once a year and we can help you make sure you're allocated properly. So with that, what I want to do is we've talked about the don'ts. I guess I have to be Mr. Negative, so don't. Mark's going to be Mr. Positive. He's going to come in and say, do. So let me turn it over to Mark.
Okay, so how do we avoid the don'ts? Okay, well,
Talking about me personally, I promise.
hey, before we get back to PowerPoint, get going on these slides, I just want to say, the other overarching reason that three of us are up here today talking about investing and market and making sure you get that right, it's critical. So I'm talking to somebody who did it right out of ignorance. They didn't. I set this up a long time ago. I just said I'm going to be in all stocks. It worked out. I look back, I had about a 7% return on my investments over my career. Now, that extra money, what did it do for me? It made the difference between me just having a basic subsistence retirement to be able to step it up, do some extra things. So I could help my son open a business. I could go on the trip of a lifetime. I didn't have to eat the early bird dinner at all the restaurants. And so, it just instead of having the basics, it gets you to a point where you have a better lifestyle. So that extra growth in your account, and that's why we're stressing so hard to get the investment part correct. So, Art, we had a lot of don'ts in that presentation. There's some things you can do to prevent yourself. And if you do the do's, you dramatically improve your chances at 7%. I think 7% is a good number to shoot for. Okay, so I'm jumping around too much. Sorry, those listening on the recording. So do keep calm, and carry on. That's a World War II statement. Remember that? Keep calm and carry on. The crises, there's a lot of them. So there's probably a crisis every month, right? The interesting thing about crises is, what does crisis equal? It equals opportunity. So when a crisis happens, or a perceived crisis, somebody somewhere thinks it's time to sell and the world's going to know. But we look back historically, every time it's happened, stocks will take a tumble on the short term, unless it's a really, really big crisis like 2007, 2008, at a short run. And out of 51 crises they studied since 1900, guess what? 6 months later, not only up, it was higher than from where it went down. So we don't want the crises. Crises cause volatility. Crises are short-term things that happen in the market. We don't want that to make us change our basic strategy and process. So do keep calm. Crisis equals opportunity. Just don't overreact. So staying invested, along the lines of Art talked about the performance gap of the people that tried to move money around did about half as well as just market. So we talk about 9 stock crashes in 50 years. What's a stock crash? They consider a stock crash when it goes down 20%. That's the way they look at a stock crash. So how about, we had a stock crash. We look at those 9 stock crashes. The one thing Art, Melissa have always been right about when we talk to people is that we talk to them about, and we say the market will come back because it is always come back. And it's just proven in the numbers and proven in the facts. If it hadn't, would we be setting new all-time highs in the Dow and the S&P and the NASDAQ today? Market was up big again this morning. So every time, you stay the course, stay invested, don't deviate. How can you do it? How can you stay the course? What makes you stay the course? You had a good plan when you started. You consulted with Melissa. So you knew you had the right plan when you started. Get the itch to move money around. Just remember the plan and go back to the plan and keep it invested, and you will have the kind of returns that you deserve. Hey, we all work too hard in this world, to end up retired and not have anything, right? Okay, goes without saying, we want you to keep saving and investing. So I ran into somebody, and he was telling me how throughout his career that whenever the market did those crashes, or when it went down big, one of the first things he would do is he'd run the benefits department and start increasing his contributions to his account. That is rare. That is very rare. That how in the world do you know to do that? What made you do that? So what was my father? Told me that you want to make money in the stock market, you buy, you add money to it. Everybody else is selling and everybody else is totally negative. That's how you can bolster your returns. So think of that. We don't want to overrun the benefits department with everybody running in there the next time the market goes down, but but that'll work. So case in point here, 2007, October started a downturn in the market, which a lot of people still remember vividly. But hey, I increased my contribution. I said I'm going to add another $100. So I ended up with $7,700 that I started putting in October 2007. And lo and behold, 77 months later, the 7,700 turned into 12,238. So just as I said earlier, it always comes back. I still talk to people who say, I just can't believe I got out of the market, got scared and got out back in 2008, 2009, stayed in the bonds and stayed in the cash accounts. But that's what happened. Sometimes it's easy to get out, but it's really hard to get back in. So if you went with bonds at 7,700 was 8,414. The money market 77.2. At least you made a little bit of money. Comfort level with risk. So did you all know you have a money personality? We all have a money personality. The extremes on that money personality is, the risk taker and the gambler, those prone to get addicted on this extent. Then you got the security-minded individual, scared to leave the house, scared of risk altogether, any kind of risk. Most people are somewhere in between, right? So kind of knowing how you personally might deal with risk can put you in a situation where you get better returns on your account. So it's sticking with the plan and knowing your limits. You have to know your limits. So the idea here is we talk about think through what. You don't ask are the stocks overvalued or undervalued. We don't worry about that on a daily basis or a monthly basis or a yearly. Or is it a good time to buy or sell? Because another long-term trend of the market is up. It's up. But we do want to ask ourselves, how much could I take? I know I need stocks. Maybe I'm not the risk taker. Maybe I'm on the other end of the spectrum. I know I need the growth. I really didn't want to have that volatility. Mark and Melissa and Art told me, don't worry, it's going to be okay. But, if I'm in a situation where it's going to be so volatile, maybe fluctuating around 20%, I might not be able to take it. So I'm going to do something a little less. How to do that? Do something. You put together a portfolio, you put together the types of funds and whatnot that fit with your risk tolerance. Because you don't want to deviate. Deviating from the plan is the worst thing you can do. We don't want you to do that. So kind of think through your money personality. The person I talked to about earlier, who increased their contribution every time it went down, they were not a security-minded individual. They realized, hey, I'm in stocks for the long run. I believe in it. I believe in the system. I believe in it. And you got to believe 100% stock. But over the long run, that strategy works too. What about saving? Save as much. Can you save too much? I doubt it. So in this example, we talk about, so I've got a goal that I'm going to hit a goal. If I save 10% of my salary 85% of it in stock, expected return of, say, 6% on that. I do that over, I can do a calculator, and it can show me, hey, if I do that, I think I should hit my goal. If I got 85% in stock. Okay, well, some people can live with that, some people don't want to. But I cut it back. Well, if I increase my savings 15% instead of 10%, then I have only 50% stock, rest in a non-stock, a bond or whatnot, but I can still hit my goal. So boosting your savings gives you more flexibility, just in terms of how you can do your allocation to hit your end goal. That's the big thing, right? Hitting the goal. By the way, who knows what is the safe savings rate? Financial planning world actually came up with a safe savings rate. It is 15%. So studies have shown, you live off of 85% of what you make. You take 15%, save it, invest it. That seems to be the formula to get people to the pile of money that they need. The one contingent on that is it's got to grow. I mean, you got to get growth on that 15% that you put away. So remember that safe savings rate. If you can't do the safe savings rate today, a little trick, a little tip, go in each year and just boost it a little bit. Give yourself a little boost each year. Diversify to manage my risk. Okay, so we want to protect Art talked a lot about diversification. So the idea here is protect yourself. So diversification is just a way for you to protect yourself from something that might go wrong in one sector of the economy, or one sector of the stock market. Okay, something went wrong there, but I got 8 or 10 other accounts here, mutual funds here, that weren't affected by that. But if I had everything in that one that went down or that was affected, I might have a problem. I will have a problem. So diversification is nothing more than risk management. And that should be a fundamental process that everyone has. We talked about your money personality, your risk tolerance. Now, manage your risk and have some spread out in all different types. Remember the quilt patch Art showed you, that colorful little chart? Got a copy of it there. Get yourself situated in a number of different investments that kind of looks like that quilt chart as far as different types of funds. 2008, stocks didn't fare so well, but bonds did well. Oh, I'm glad I had some bonds in my portfolio. 2000, 2002, remember that? Y2K. Remember 1999, I even fell victim to the trap of getting in all those internet stocks, the .com stocks. So, hey, but I didn't have a lot in there. It did go down, but I had myself spread out, so I had myself in some different areas that did do okay. Diversify by goal. So we've got money, so we got to think outside of retirement plans. That isn't our whole financial life. We've got money. Hopefully, we got money in an emergency fund. Everybody got 6 months worth of expenses in your emergency fund. In case something happens, you put your hand on cash. So we save for emergencies. We don't invest that, typically. Let's put that in someplace safe. I'm going to buy something in the next 6 months or a year. I'm saving for it. I don't necessarily invest that. So we do our investing, or our stocks, in longer-term portfolios. But maybe I am that personality that I got to scratch the itch. I need some risk. I like having a little bit of adventure in my life with trading stocks, trying to hit the Amazon that just went in public. So along those lines, there's nothing wrong with setting up a Mad Money account. So you set yourself up a Mad Money account with a brokerage firm, and get involved. This is healthy. This is good stuff. It makes you learn, you gain knowledge about how the markets and the stocks work, and you might hit something. You might lose it all, but you might hit something big. So that's a Mad Money account, or a section of your account that's in the speculative area. We don't consider the stuff that we do that speculative. Ours is pretty much the boring mutual funds. They're going to plod along with that 7% return over the long run. So rebalancing, I spoke with someone recently who said, I thought I might need to call you. I haven't looked at my account in about 7 years really closely, or made any changes in my account. But I set up what I think is a good allocation. I looked at it, it was a good allocation. It was about 7 years since he'd done anything, since he put it in place. So we go back. I say, this is fine. You're diversified correctly. You've had some good performance here. But the thing about it is, this doesn't look like the percentage allocations don't look the same as they did when you set this up 7 years ago. Why? Well, some of those funds outperformed, some of them underperformed, so the percentages get off. So your accounts get out of balance. Now, we got an easy way that you can realign or rebalance your account with ICMARC. You just log into your account, and we got a little section that says realignment. Throw yourself back in. That's a good idea because the balance, what it does essentially is it'll move you out of the stuff that's overperforming, and it'll move you back into the stuff that's been underperforming. Now, you might say, why would I want to do that? Because of the cyclical nature of markets. So the thing that's overperforming at some point going to stop, probably underperform. The thing that hasn't performed is probably going to come back and start performing. So when you rebalance, you make sure that you stick with the allocation you started with, and most importantly, stick with the same risk profile. When should you rebalance? The pros say, some like every couple of years or so. We rebalance our managed account every quarter. The one thing I did want to add on here, something to do, Art kind of alluded to. When you get in a situation, you've had some guidance, you put this together, and it's worked out pretty well. Funds in your account, and maybe you've hit your goal. So the question people will ask me, when do I kind of jump off this train, growth train? When can I stop thinking about growing my money? Well, obviously, if you've hit your goal that you set to savings, that might be a time when you can take your foot off the accelerator and kind of back off. So you don't have to stay in volatile type investments or growth-oriented investments. Once you hit your goal, once you have enough, there isn't an urgent need to do that. So you're getting close to retirement, for example, and things are looking pretty good. You're 5 years away. Maybe you back off this something. You go into something, you set up a nice cash buffer. So when you start spending the money in that account, you know what you can have, what you can spend, and you don't have to worry about it. So keep in mind, getting closer to retirement, it's a little different strategy, and we can certainly help you along those lines too. Just to recap, we want to stick with the plan. Obviously, everybody has their own customized plan and money personality. Remember the 15%, the safe savings rate or savings boosts. Market goes down, maybe I put some more in. Maybe I try that strategy. It seems to always work. So I'm going to be diversified. That's easy. I'm going to rebalance. That's easy. So I hope after all this you realize this is a lot easier than you might have thought it would in terms of putting together your initial allocation, sticking with the plan, rebalancing it. It's not that difficult at all. And you keep it simple, you will be a lot richer when you hit retirement. Thank you. Now, we had a pleasure of introducing. We'll move forward there. Thank you. Enjoyed being with you this afternoon.
Okay. So I get to do the tips and tricks of the trade, but that sounds too gimmicky, I think. So, well, the first thing that I want to say, because Mark said the word crash, and I don't like the word crash because it's like an F word kind of in our industry. So I always tell folks, don't use the word crash, use another C word, correction, because that's really what it is. It might feel like a crash, but it's a better for my mindset, so it might help you too. Think of it as a big correction, not a crash necessarily. And I'll also share with you my money personality, and I'm a total stereotype. I'm a spender. I love spending money. I like shopping and all that good stuff. And I have my husband to keep me in check for that. He's a saver. So it's good if you're in a partnership of some sort, probably one of you's one personality and one of you's the other, hopefully. Sometimes you get in a situation like my brother, who he and his wife are both spenders. So I always worry about them, and he's my little brother, and I'm always trying to give him advice that he doesn't want to hear because, you know, he's a hotshot lawyer now, and he knows everything. So, but I'm like, I'm the money person. You got to trust me. So, you know, it helps to have somebody else in my household who is the opposite of me, money personality-wise, for sure. So, did anyone in here go to business school like I did? Nobody? Not one person? One person? Two people? Okay. Well, we went to business school. So has anyone heard, though, making a SMART goal, using the acronym SMART when you're making goals? Make them realistic, time measurable, all that and good stuff. So with investing, it's no different. You need to have some sort of written out plan that you're going to follow, and you're going to follow kind of that, I say that SMART acronym when you do this, because just like any other goal that you have, if you don't have some sort of something written down of what you're trying to achieve, what's the likelihood you're going to get to that end goal? And a lot of folks will tell me, well, I just want to have as much money saved as possible in my account. Okay, well, don't we all? I mean, so do I, but we need to know what you're going to need. What do you need in retirement? What do you need out of your 457, 401 to supplement income? And how are we going to get you there? So we need to have something written down. We need to have something, you know, specific that we're trying to attain. And I think the second bullet point here is pretty important, because certain things are going to happen and where you're going to want to change course, but maybe you shouldn't be changing course. And the two guys over here have touched on a lot of those things, but I've met with folks. Recently I met with somebody who said, well, my coworker told me that, you know, he showed me his account and he has this fund, Fidelity Contra Fund. Has anyone heard of that fund? He said, he has that fund and he's gotten like 22%. And, you know, I think I should be in that fund. So that's one of the examples of times not to necessarily make a change, is just because your neighbor or your friend or your coworker or someone who thinks they're a financial expert is telling you what hot stock or investment to get in next. Everybody has different goals. So what's good for one person is not necessarily going to translate to what you should also be invested in. So when we sit down with you, when I sit down with you, we want to look at, what are you doing? You know, what do you need? It's going to be different, and probably everybody in the room is going to have some sort of different circumstances, whether it's a different goal, different amount that you're saving. Maybe some folks have pensions from previous job or military, some folks don't. So that translates to different investments, different goals, different everything for everybody. So that's one example. The other example I'd say is, you know, market ups and downs. When the market's down, everybody is a very conservative investor. When the market's up, everybody's a very aggressive investor. You need to find out what you are regardless of what the market's doing. So, you know, finding out how you feel personally about risk, but also seeing how you need to be invested to get you to your goal is more important than whether the market is up or down. And we're going to talk about emotions in a little bit here. So monitoring your plan, this is another part of that kind of SMART goal that we talked about here. I don't know about a diary. That seems kind of outdated, but you know, we have a tool online. It's called Am I on Track? Has anyone looked at that before? Probably a lot of you that have sat down with me have looked at it, because I run through that with a lot of folks. That can be your written plan as well as the monitoring of the plan. Because if you're enrolled in that program, or if you've put in information in there, we can always go back in and check in. Do I need to be saving more? Am I in the right investments? Those kinds of things. So that can substitute for the written part of your plan, or where you can check in to monitor it. It's really easy to use, a lot easier in my opinion than just getting your paper statement and saying, okay, well, what does all this mean? You know, can you explain to me how to read my statement? That Am I on Track tool online is much easier to understand. And maybe record reasons that you made investment decision changes. I'm hoping you're not making investment changes that frequently where you've got to do this. But again, it shouldn't be, well, my coworker told me I should do this, so I'm going to make that change. You might look back and look at that note and say, well, why the heck did I listen to that guy? Look what he's doing now. So I don't know. Again, your Am I on Track tool online, that's going to be the best place for you to kind of keep this written plan, as well as monitoring the plan. So risk is something that I feel like a lot of people maybe have different ideas about what risk actually means. So what does risk mean to you? Throw out some words or things that make you think of in the market when you hear the word risk. Not safe. Okay, that's a good one. What else? Failure. Taking a chance. What else? Volatile. And so all of those kind of funnel into one thing as far as I'm concerned. What about the risk of not having enough money? Is that also a risk? What about the risk of not keeping pace with inflation in retirement? Or not saving enough money? So there's two sides to risk. You know, our human brains, I guess, tend to think when we hear risk, we think volatility and ups and downs in the market and crashes, you know, that bad C word. But we also have to think of the other side of that. We have to find a balance between not taking on enough and not taking on too much risk. And we can help you with that. Mark said all this stuff's really easy. Probably the hardest part is what investments should I be in initially? I mean, we can help you with that part. As far as monitoring, though, that part should be the easy part. You know, checking in and meeting with us if you need to and those kinds of things. So does anyone know what the average inflation rate is? Well, how about this? What is inflation? The price of stuff going up, right? Every year, on average, does the price of stuff go up? If we look in the future 20 years from now, is the price of stuff going to be more? Like if we look back 50 years, is the price of stuff less than it is now? So that's probably a pretty consistent thing we have to think about, even once we've retired. So most folks just think about the time horizon getting you to retirement, but we also have to think about your life expectancy beyond that, from when you retire until you die. Now, some folks will tell me, well, I'm probably going to drop dead 2 years after I retire. You should just live it up then, okay? But we have to plan more conservatively than that. You know, you might live 20, 30 years in retirement, and that's another time frame to think about as far as inflation and making sure your savings are still growing enough. So it doesn't just come a point where we just say, let's freeze it all, you're retired now, because hopefully you're going to have a long and, you know, enjoyable life in retirement too, and we need to account for that time frame as well. Okay, we've heard this word too, diversification, which means we want to have a little bit of money in kind of all different areas of the market, right? So who's heard the saying, don't put all your eggs in one basket? So putting all your money in Fidelity Contra Fund is putting all your eggs in one basket. And with that quilt chart that we showed as well, we know that not the same sector of the market's going to overperform or do really well every year. We need to make sure we have a blend of those investments so that we're not only not going to see drastic volatility in our account, but also to make sure that we're in the right mix of investments for our specific retirement goals. So, you know, there's stocks, bonds, there's cash, there's within the stocks and bonds, there's international, there's large, there's small, there's mid, and all that stuff can get a little confusing. We can help you with that stuff again. So if you're looking at that going, you're speaking another language to me, I have no idea what all that means, we can help you with that. And, you know, we can help you kind of break it down and explain those different asset classes better. But really, you want to make sure you're in a blend of investments. And that's for retirement savings. It also says cash for rough stretches. If you have, I think Mark mentioned, if you have a goal coming up 6 months from now or a year from now, we don't want to put that money 100% in stocks. Or our emergency savings, do we want to put that in stocks? Like money that I need if the water heater goes out, or, you know, no, we don't, because that could fluctuate pretty drastically on a day-to-day basis. So it's good to have some cash in your portfolio for short-term stuff as well as emergency savings. I know too many people, and we probably all do, maybe we're guilty of it too, that don't have a good amount of money in our emergency savings in the bank, maybe, for things that come up, because we get a lot of requests to take money out of retirement accounts when there's just, you know, emergencies that they feel like real emergencies to us, but a lot of them are things you should expect as either a homeowner or owning a car, you know, things like that. Things break, we need to replace them. So that's more short-term savings, that's emergency savings, and that's really what you should have in cash. One more thing I'll say here is, I do meet with a lot of folks who will just say to me, I'm looking at my portfolio and I wish I had more money in there. But what can I do about that? And they're looking for some sort of kind of investment, I don't know, some like magic tricks or something, but what do you think I tell them if they say that to me? What can they do to have more money in their account? There you go. Oh, look, everybody's well trained in this room. Yes. Save more money. So we talked a lot about investments, but investments are secondary. The importance of the investments in your portfolio is secondary to how much you save into your account and how long you save for. So the amount of money that goes in and the time, those are the two most important things in getting you to a successful retirement. Not did I pick Fidelity Contra Fund over this, S&P 500 fund. So investments are secondary. Remember that. If you want to have impact on this, you start as soon as possible and you save as much as you can. That's pretty simple. And those are things we can control, right? We can't get back time, though, so start now if you haven't started yet. You get a really good match here. I'm assuming everybody takes advantage of it. But if you're not, meet with us or meet with HR. We're happy to get you started or increase it if you want to do that too. So we do have some, they're called balanced funds. They're basically kind of pre-made portfolios that you can use if you're not sure how you should be invested. So there's a series of funds. There's a series called Milestone, which are just a target year. And there's also model portfolio funds, which are a target risk. You can pick basically based on when you want to retire or how fast you want to go. That's kind of how I describe those two series of funds. Milestones are when I'm going to retire in this year. I'll pick this fund with this year. Model portfolios are based on risk. You say, I want to be really aggressive, and you can pick based on that, or I want to be really conservative. So it helps give you a kind of pre-made blend of stocks, bonds, and in a portfolio based on your age or how aggressive you want to be. If you want a little bit more customization, we have managed accounts. I know a lot of people do use that as well. We'll actually proactively pick funds for you and rebalance. These balanced funds do rebalance automatically, and they kind of, the milestone target date funds, they do adjust with you over time. As you get older, they get a little more conservative. Model portfolios don't do that. So, I mean, if you pick a very aggressive investment, it's 20 years from now, it's still very aggressive. So just something to keep in mind. And, if you want to be as hands-off as possible, the managed accounts is definitely the way to go. Okay. So the market goes up and down during the day, right? What is it specifically that goes up and down during the day, though? The price of what? Oh, I hear it. Yeah. Say it louder. Say it loud and proud. Stocks, right? So throughout the day, a stock price, it can start somewhere when the market opens, and throughout the day, it can be all kinds of different prices, right? So what about mutual funds? Because we don't have stocks in our retirement accounts. We just have mutual funds, which are kind of a blend of investments. They are only priced once per day. So a mutual fund does not fluctuate throughout the day. It's priced at the end of the day every day. So automatically, it's a little less volatile. And if you're watching the stock market, with a mutual fund, it really only matters what happens at the end of the day. Let's say the market tanks, but then comes back to where it was by close, you're fine. Right? You haven't, even though you see that volatility there, just keep in mind mutual funds are only priced once a day, not like stocks, which can fluctuate throughout the day and can also be sold and bought throughout the day. So it's important to not look at the stock market too much unless you can emotionally detach yourself from that, which a lot of folks can't. I mean, I would argue that probably 99% of what happens in the market is because of emotional stuff, right? I mean, all kinds of things can happen in the world, in politics, but it's really how we react to it as investors. That's what happens in the market. We agree with that? So it's a very emotional place. And so it's important to, when we set up a recommendation, or we help you with investments and things like that, we're sticking that up for the long term. We're not looking at what does the market do day to day. That can get emotional. Now, some people like to do that, and they can detach. But most folks can't, myself included. I mean, I don't look at my 401k every day. There's no point. I'm not retiring for a while either. That's probably the other side of it. But even if I was, once a quarter is enough. That's enough. If you've set yourself up the right way, you don't need to be looking at it every day. You're in the right investments based on your retirement goals. So if something changes in your personal life, let's say you have a working spouse and that spouse loses their job, and now you're living off of one income. That could pretty drastically change things on a day-to-day basis, right? So that might be something where we say, hey, I need to reassess what's going on. Or let's say a spouse passes away and there's no more income there. Or now I've got a plan just for me. I mean, I'll meet someone else, but I've really just got to focus on me now. So there's things that can happen in our lives where we want to reassess our financial goals and our retirement goals. But it's not just the market went up, the market went down, or, you know, my coworker told me I should look at investing in this stock necessarily. What about kids growing up and leaving the house? That frees up quite a bit of cash, right? I wouldn't know that. I have an almost 2-year-old. Yeah, thank you. And we just enrolled him in Montessori because Mama needed a little bit more of a fixed schedule, which I didn't really have before. And so right now my husband said we need to cut all non-essential spending until we get used to this additional monthly expense. And I'm like, but I was just in Target and, you know, I saw this cute clothes. It's hard, but things like that, I did need to reassess and look at what am I spending, because now I've got this big bill that's coming every month on top of all the other bills that we have to pay. So, you know, that's a life change that I've had, not just having the kid, but, you know, a life change that I've got to deal with personally. Okay, so this is the last step, and I think the most important one, manage your emotions. That's the thing that typically gets the most out of check, I think, for all of us. So whatever we have decided or you have decided upon, we want to remember that plan. That's what we set up initially. That's what we want to stick with. Unless there's some sort of drastic life changes where we need to make adjustments, we want to stick to our plan. And it does say involve others, but I would say involve others, maybe professionals. You know, if your cousin says they're real good with finances and they love going online and watching the stock market, that doesn't necessarily mean that's someone you maybe want to involve with your retirement planning. But ask others, ask professionals, ask us. We're here to help you. You know, if you're thinking you might want to make a change, talk to one of us first. You know, maybe we can give you kind of a more unemotional opinion on what you should be doing. So we hope that we are the good, trusted advisor that you come to when you have questions or need help with your investments. But if you know someone else who can do that, you know, consult them. Just like in any other area of your life, if you need medical assistance, you're going to consult a medical professional, right? If you need help with your car and you don't know how to work on your car, like me, I'm not going to try to do that by myself. I'm going to, you know, find a trusted individual that I can go to for help. So same goes with your finances. Same goes with retirement. So we are right up at the end of our time here. So if we have questions, I don't know, Marcia, you... Yeah, if y'all need to go, please do. If y'all want to hang around just for a couple minutes, then for those of you who do want to hang out, who has the app downloaded on their phone? 1, 2, 3, 4, 5. Okay. So if you go to the App Store on your iPhone or the Google Play Store, if you have an Android, you can download the app. You just look for ICMARC, and it'll pull up the app. You can get set up if you've not been set up online before on the app as well, what the app looks like. Or if you've set up online, you can use your same user credentials to log into the app, and you can view a lot of things that, you know, we've talked about. Am I on track? We have a service called Text Access as well. Is anyone using that? You're really advanced if you're enrolled in that. You get a gold star from me. Okay, so we do have a service called Text Access as well, where you can enroll your mobile number and have certain things texted to you. So you're not going to be able to see this too well because it's small, but it's going to give you a list of commands that you can send to us, and we can give you information. Contribution. What's the last contribution that I made into my account? What's my balance? What's my rate of return? What's my loan balance if you have a loan in your account? So rather than having to remember all those login stuff and security questions and all that junk, you can enroll in this and get a lot of your questions answered right from this app. And you can try to break it. You can send it. I just sent it 3 question marks, and I got, you've entered an invalid command. Here's what you can send to us. So you can't break it. You'll always get the list of what you can send, but use that as well. You know, if you want to just real quick want to know something, the Text Access service can most likely answer a lot of those questions for you. Any questions for anyone who's not? Please go if you got to go. I'm not trying to hold you here, hold you hostage. Whoops, oh, I exited. Okay.